Hi and welcome to Equities Bank. My name is Jonas Thulin. I'm head of asset management, and I will try to go through our house view. I think this week is even more exciting than previous weeks, and that is because the peak they've seen so clearly in a number of CPI measurements and models indicators will finally hit turf not only in the headline CPI number but also in the equity market. This is a huge call. It has been a house view since March and all this year, trying to hold on to equities. And for us, that has worked, given the fact that we are a very tactically active house, i.e. for us to be overweight equities has even beaten listed competitors without taking out new lows since June when we allocated up our equity proportion and took off hedges and invested our last cash. And that is a combination and foremost a function of our tactical work. This is the same page as last week where we indicate that on a global benchmark basis to be 60-40, 40-60, doesn't matter, you have the same result, i.e. by allocating more to equities, if that is your mandate, which we have in global mandates, you pretty much have a free option to hang on to equities if you can sort of work with a tactical environment. For us, I think the last 3 months, this is the global index in pink purple, and you can see the number of strategies that we have that return better than global benchmark is the majority. A few of our strategies have even returned some 15 to 18% on the top side, which is quite remarkable for 3 months. On top of that, we add a currency overlay, which we mix between dollars, euros, and sterling, in fact. So for us, this trough in June is holding up very well. We think the trigger for this coming week could very well be on the 13th with the CPI number from the US. And even if that was not to occur, we're going to hang on for next month because we have built enough buffer in our global equity mandates to take that. I.e., we are not making new lows in our global equity portfolios, even though global benchmarks are as a combination of the underlying strategies that we have chosen and, of course, on the FX bets that we are running as well. And you can see up here that we are actually on a 47% exposure to dollar, 39 on the euro. And remember, back before the war, we were at 98% dollar. So this is a quite dramatic shift for us. And we're doing that just to sort of roll and time the development of the stocky. We've even put in US clean tech equities in sterling. Due to the fact that even sterling is performing better than the Swedish krona, despite the minimum budget that has come from Liz Truss and her colleagues. We have decreased our dollar exposure by another 10% since our trough in June. And for this year, from 1st of 1st, 2018, we returned some 62% or 54-ish if you go for the more sustainable that we're doing, and versus the global benchmark of 13. So obviously we are outperforming the global index this year, both due to our work on FX, but more so, I would say, in terms of choosing the right strategies, underlying strategies. So we're going to keep on with these quite narrow strategies. I like battery take, like emerging markets, Latin America, not too narrow, but you see what I'm saying for being a Swedish house. Water purifying, biotech, cybersecurity, and clean energy again. We have both in euro and in sterling, and small caps, etc. So for us, the overall strategy is pretty much unchanged since the last time we recorded this, like a week ago. We believe that we're going to end up in a Federal Reserve hawkishness. We believe that has actually already happened, which is a big, a statement. We think yields will peak and are peaking right now, and we think peak inflation is already played out. This is a fairly confused world. We believe the risk reward is to hang on to equities by being very active tactically, because if you're going to have a break on the upside due to the fact that inflation is rolling over, it's going to be on the equity side. We're going to make more money. You have to be prepared for it on the fixed income side, which we are actually introducing right now in the portfolios. The early October is developing almost 100% according to our strategy. It will not be that way going through the year, but we are happy to see that beginning of October at least. We still believe, we will prove in this presentation, that earnings revisions, they have troughed. Price target forecasts as well, economic momentum where we invested, they're troughed as well. And this is obviously a much needed development in a year where we are still down and we're still struggling with portfolio returns. Now, in terms of soft or hard landing, we believe that we're still in a soft landing camp. And the pace by which the job openings are disappearing from the US economy is quite dramatic. This is the reason why the market took away or priced out one hike from the Fed next year, i.e. this drop in job openings was enough to eradicate 25 basis points, actually 36 basis points of hikes next year. That is quite a dramatic shift. It caused, amongst other things, an explosion or almost a upside jump on the equity market. We believe more of this will happen, and we believe the market will play it like that, because this basically what we're witnessing right now is that peak inflation that we've seen in fixed income markets will move into the equity market. Now, I mentioned commodities, which are obviously a vital part of this whole inflation thinking. And if you look at, for example, oil demand, or if you're looking at the Z scores of a number of different commodity factors or markets, you can actually see the Z scores are turning red, i.e. more and more downside momentum in terms of positioning. We think that's quite leading to spot price development. As such, we have taken profit in our commodities, and we keep a small proportion as we can from a legal point of view, given different mandates. But as much as possible, we're out of commodities. We were quite heavy in soft commodities, but that was obviously driven by the war in Ukraine, but also the fact that the percentage of excellent or good field conditions in the US plummeted from some 65-ish down to high 20s or low 30s. That, on top of the war, created a huge move in wheat, for example, and other soft commodities. For us, this sort of second derivative and that kind of peak, when this little rebound, that's a perfect take profit for us. We could potentially miss out something more, but then again, we're in line with the overall market. The people are withdrawing and putting on short positions. We think that's actually makes sense. So that's obviously linked to the inflation as well. Now, price inflation, as you all know, peaked in March. There's no news here. What is actually happening now is that the fixed income market can tick the box on more and more underlying conditions that are proving that they are the right. They trade this the right way, basically. What we're expecting now is that the equity market will wake up to this, and they will by the time that the Fed is going to start to revise their outlooks, etc. We're not there quite yet, but the market's going to try to front run this. So price inflation lower, cash expenditure at the gas stations lower. We have the arithmetics, i.e. the 22nd of October, the base effects are turning south in US CPI, i.e. if the month-to-month increase in US CPI is less or equal to 0.3%, you will have a 2.5% inflation next year unless something extraordinary happens, which our indicators show it will not happen. This is why the Fed is quite cool in their forecast, 2.8. But also why the market is, as you can see on the equity market in early October, they're quite eager to jump on board this ship, because once it gets going, that will be probably or hopefully the next big trend in the equity market. Now, we can build on this case by putting in, yes, the bottlenecks have completely disappeared from the economy. I.e. all of a sudden we have huge inventories. That wasn't the plan. And now, like Nike, they have to slash prices and make huge realization campaigns in order to get rid of the inventories, i.e. you're going to push down inflation. That is nothing new. That is sort of the cyclical relationship we have between inventories and CPI. So that's one big factor on top of the pricing on the gas stations and the pricing on break-evens. And then you can look at homeowners equivalent rent, i.e. the rent price, which is a huge part of CPI. It's not growing on the upside anymore. You can look at the 10-year in price inflation. It's not budging from their view that this will pass before we hit the 10-year mark. And you look at the commodity market, clear peak. You can look at the 5-year swaptions. They moved from almost 10% down to even below 2% a couple of days ago. A huge move in how we view long-term inflation pressure. US inflation is pretty much following what we've seen in Brazil already. This drop-off in Brazilian CPI will probably happen in the US as well. On top of that, you have traded inflation expectations. They're redoing the same trick we did in not only March, April, we saw a bounce in the equity market. They redo what we did back in June. That trough for us in the equity market is holding quite well. So for us, that was the right call to take away the hedges and use our last cash. i.e., obviously, given the fact that inflation expectation was trading against us, sort of hurt the global indices a lot more than our portfolio, which we are thankfully and lucky to sort of avoid. But for us to see that turning point, which is pretty much building up the same kind of environment we did in June, is of course perfect. Because if we can redo another leg up in the equity market, our trough since June will look, in hindsight, very well. And that's obviously what we're hoping for. So we're pretty much repeating the same connection that we have repeated before. Price inflation is moving down, or price inflation expectation is moving down in line with the break-even markets, in line with a lot of other markets, and the equity market will respond. Now, the supply bottlenecks are deteriorating, or not deteriorating, they're disappearing rapidly, which is not uncommon. This is usually what happens. We build them up through years, and then all of a sudden, poof, they're gone. And you're stuck with a lot of inventories, and you have to slash prices. Pretty much the same old game that we have played a couple of times. What always surprises the markets is the speed by which the supply bottlenecks are disappearing. And you can measure that on different indicators, and you can see it in our own indicators, et cetera, et cetera. It's pretty much a given. If you look at the delta within the CPI, you can actually see it turning around as well already back in March. If you look at underlying or other variables, you can actually see that turning south, especially if you look at the commodity area, which is why we decided to take profit in our commodity exposure. If you look at it in terms of positioning, you can actually also see a clear peak. Not the best model in any sense, but what I like about this is it's just pure raw positioning in commodities and actually FX versus the 5-year priced inflation. So it's turn for the 2 years, turn for the 5 years, turn for the 5 year. Again, March being the clear peak. This is all news for the fixed income market. What is new is if the equity market will wake up, which has been our view since March. And I should be perfectly honest here and say it's a view that's quite easy to hang on to, given the fact that global rates are performing as bad as global equities on a benchmark level, i.e. you're almost given a free option. And if you're able to work tactically, you can use this year to beat the index and build a great basis for the rebound, which has sort of been our strategy so far. If you look at prices paid, prices received on the corporate side, you're not going to get so much follow through. If you look at the supply demand factors, i.e. US has had a great deal of demand-led price inflation, which we don't see in Europe, and you can't really see that anymore. If you look at the labor share, you can also see a clear downside. Again, not too often updated data we have on this, so it's a bit clumsy in that sense, but it certainly doesn't go against the conclusion. Price plans next 3 months, yep, they are developing on the downside. Wage pressure, as Powell pointed out in his press conference, weaker and weaker wage pressure. If you look at the difference between compensations and price plans, you can actually see that the price plans did increase and are now deteriorating quite rapidly, while the compensation plan is virtually almost back to where we were before the pandemic. The spread is huge, and if anything, this spread is closing rapidly on the downside. So again, not a lot of follow through. And if you look at the consumers' 1-year inflation expectations, we're still sub 3%. If you look at the break-even curve, they're breaking lower again. So our bet or our strategy has been that equities wake up to this. Now your patience for this is entirely depending on how you can work on your tactical asset allocation. And for us, that is sort of making this trough in June to still work. For us, we can afford to be patient, basically. So we're hoping that the number next week will prove us even more right. If not, we're just going to wait for another month, because we're quite certain that all these factors will be playing out. On top of all this, we also have that the balance sheet reduction is putting a lid on inflation. Now this means, obviously, the Fed Fund futures and the market is sort of in charge of pricing Fed are not blind to this as well. So the peak that we saw before, there was going to be a long waiting, hike up to 4.5%, you're going to wait for a while and then you're going to start to cut, has shifted into a quick hit and run. So you increase and then quite rapidly, i.e. next meeting, we will actually cut rates again. Now, obviously, it won't be that spiky, but I think it's interesting that not only have we taken away the most hawkish pricing in the market and shifted down to more fairly neutral, this is also triggering, obviously, the equity market. Now, in order to accentuate this even more, we have taken a long position on the 10-year treasuries cash position. quite blunt in that sense. We have decided to trade it in euros, so we're taking away a little bit of the dollar risk there. But pretty much, this sort of accentuates our whole strategy, where we're shifting from a long commodities to a long US Treasury position to really accentuate this, that we believe that the CPI will turn lower. Now, that can be right, and I can be completely wrong. We have to wait and see, but that's where we put our foot down in order to try to grasp more value in the market. And we like, of course, that we're not doing this completely blindfolded. We have the swap spread market indicating that statistically, you're in a better position of being long US Treasuries than short. Now, what we also like in terms of equities, just to run through that very quickly, second derivative of margin debt is turning up, which is always good fun, still negative, but at least from a market point of view, it's more fun when we growing with that kind of sign on the second derivative. If you look at the rate spreads or CDSs or vols, you're still below what we think is a benchmark. We use the break lower to reallocate. That's when we bought biotech in the US. But we're not taking away equity risk, because the alternative is to a large extent not as good as keeping equities going into October. That was our call. It has proven to be a quite good call so far, and we humbly hope that we're going to continue to be able to make that profitable, basically. Intermarket risk, very low, no problem. This slide is quite interesting, because if you go back a week, what we said last Friday is that you saw a rear event, i.e. the internal market factors were showing an upside. We all know that last week the equity market was bombarded on the downside. And then all of a sudden on the Monday, it pretty much has to race up to what already had happened. So that means that already by the end of last week, we could see a positive setup between highs, lows, advanced declines, bullish, bearish on the wall curve, and now even more so. So we believe that the market is, and we can also see that from a HUBA liquidity ratio, the market is prone to be on the buy side and a lot less on the sell side, which is quite interesting. I think that has to do also with this page or this graph. We're looking at the breadth, i.e. the percentage that's trading below their 50-day moving average and the 14-day RSI. We showed that last week, where we said this could lead to a trough in the equity market. So far, so good. We have to see if it holds. We'll be quite hopeful for that, as long as this indicator is bidding on the upside, together with this indicator, of course. Most important for us is this overall market risk indicator that we look at, counterparty risk and dollar liquidity and vol curves. And what I think is pretty interesting is that low we saw back in April coincides with the fixed income market from March. And since then, we've just been trading in a better environment relative. But the equity market has been taking new lows, notably not us, from the June low. But we're hoping that we're going to repeat basically what we saw in June, and then hopefully we're going to keep on for a bit longer than we saw in June for the raw index. But we're still obviously very happy with the fact that the trough for us was back in June. But what is quite interesting now to see the amount of space that the equity market is lagging the other risk markets. Now we believe we're going to end up in a positive gamma. We are in positive gamma today, but we believe we could actually be even more positive going forward. On the option side, we like the fact that the put call is troughing as well. It's quite important. From a PE, like the inverted PE, taking into consideration cyclically adjusted PE, and also taking into consideration the 10-year yield, you sort of get this kind of Fed variation model. It's pretty much, it's not the best to trade on. We don't use it to trade on. But what I quite like is that we saw a break from expensive to cheap equities for a while ago. Now, importantly, I think this is a lot more important when we calculate if the market is more willing to be on the buy side or sell side from a purely numbers game. And what we can see there is a bidding higher, lower lows. Not lower lows, higher lows. It's quite interesting that the market is clearly indicating they want to be on the buy side. We're not as interested to sell as we were a little while ago, and obviously that's great for the equity market if we get this whole inflation game playing out the way we want. On the bear market indicator, we still see an upside potential there as well. Now, notably, if you are invested in Sweden, we have made a huge work on single Swedish equities, where we pretty much shifted out those equities or those companies that had a too large proportion dependence on Swedish macro. and moved it towards companies that are more internationally based, or the customer base is international, or they have a currency mixture that makes it work. I think that's very important, and the key reason for that is this page, where you can see that what used to drive Swedish equity market, this black line, was U.S. macro, and that, unfortunately, relationship has cracked or fell apart, and the relationship between Swedish equity markets and Swedish macro is increasing. Now remember, Swedish economic surprises is completely deteriorating whilst the US is improving. Swedish industrial production, for example, has made a huge shift downwards. Now, for us, that means that we are shifting into ABB, Munters, even New Wave, i.e. those corporates that are expanding abroad, basically. And we think that's quite important now to speak to your broker about, what corporates can actually survive this environment on a relative basis even better, or outright well, and not end up in a equity mix that is too much depending on domestic Swedish factors. And obviously, this is no surprise. We've been speaking a great detail about the collapse we've seen in retail sales. Remember, Swedish retail sales is the lowest we've seen since the 1990s crisis or the financial crisis. We have rate hikes depending on a supply shock. There are no wage pressure in Sweden. We have even a labor market that's sort of, it is right now as good as it's going to get. And we're sort of already in that environment where you can compare us to Spain and Italy in terms of youth unemployment and adult unemployment. We also have the high systematic stress in Europe. We're actually shifting away now in terms of corporate credits. We find more liquidity in emerging markets than we're doing in parts of Europe, in fact. So it's quite a lot of interesting stuff going on here, which we think you can actually take a full advantage of, knowing that we know this is going to happen. This is what is happening. So you have to shift and work with your portfolio. So we strongly advise, as always, to speak to your advisor or your broker about finding these corporates, and we can just lead by example. And as you can see in our discretionary portfolios, we have shifted out a great number of companies on the local Swedish stock exchange for a number of others. So the clouds are gathering in that context. We're not being too depressed for the time being, obviously, of keeping the money in play. But I think it's interesting to work with the positions in that sense. Now, also remember very quickly, the spot market, if you move globally, has already priced EPSs in the US as we were going to enter recession. Remember, the EPS models are troughing. If you look at earnings revisions and global GDP tracker, they're all troughed and turning on the upside. Usually, equity markets lead this development. Right now, actually, equity markets lag. For us, that's a great opportunity to build positions because we get free time. We have a free option given that rates are performing badly, and we have free time given the fact that the equity market is beaten down in the shoes by Fed, by inflation, everything, which makes perfect sense. But if you're able to play around tactically by keeping the trough in June to hold, and you can keep that, we all know that the surprises on the equity market will be on the upside, not the downside, as long as the US doesn't enter a recession, which is not our call. So I think this graph is very important to also remember that earnings estimate revisions have actually troughed. And they're troughing because the equity market or the corporates are saying that things develop more positively than you have in your forecast, either speaking to the analyst environment in an S&P 500 basis. And obviously, by looking at the earnings revisions, price revisions, and economic surprises, we still see upside surprise, which we have been arguing for now for a couple of weeks. It's obviously a lot easier to argue for this when we have this week's positive equity development behind us. But we're just going to keep on nagging about following this data and try to construct the portfolio to take advantage, because we all know that missing the best equity days is a lot worse than avoiding the worst equity days. So you cannot afford to miss the bounce. And if our bounce since June is to be proven that it actually holds towards the year end, there will be a huge call that there is going to be a really profitable, hopefully on absolute terms, but definitely in relative terms. Now, in terms of the business cycle, nothing new here really. US is beating Europe in terms of now cost models. It's still in expansionary territory if you look at growth and capacity utilization. Recession risk is still 25, a bit below 25%. What's a bit new is that if we take the New York Fed's recession probability indicator and break it down and see how it's constructed, we can actually replicate it, but also speed up the dice a bit. in order to make it a bit more nervous. And that's what I've done in this green model. It's a bit more fluky in that sense, but what I think is quite interesting are our signals right now that all of a sudden we can see that, well, hang on a minute, we actually don't see increased recession risk for the US, which sort of was a real case for us 2023, 2024. But actually the model is starting to turn lower. If that is to be true, that's a great signal for us, but we still keep a sort of, let's wait until we get there. We're still a bit more concerned about 2023, 2024, but we also know that's when the Fed will start cutting rates, so no real panic there as of yet. The recession risk for the next 12 months in the US is still 22.3%, so no upsides, nothing extraordinary happening there. In terms of hard data, i.e. lumber prices, car loads, containers being full or empty. If you look at electricity usage, steel usage, or cement usage in the US, or anchor days, or ship volumes, they're still developing positively. We can't see hard data collapsing, i.e. we can't see a recession that people were talking about, and still some are talking about recession 2022, which makes no sense to us. It didn't make sense to us and still doesn't. We might miss something, but we can't really see it. In fact, if you look at the Atlanta GDP model, it's the best GDP momentum we've now seen that we have seen since late January. Obviously, that's a great little interesting signal that we keep on track. Now, this might look like a spaghetti graph. So if you look at on weekly GDP nowcast models, you can still see a positive momentum. So if you look at real-time SAM rule, or if you look at the Aruba Diebold Scotty business confidence, you can't see this recession that people keep talking about. If you look in our own nowcast model, you can't see it either. Now it might happen further down the line, but we all know that's a bit too early to trade before we actually see it in any type of data, unless you play around with sort of a long-term option strategy or something, which we have chosen not to have today. In terms of the data that actually defines the US recession, you can actually see that since last week, we have a little move on the upside. We keep on improving in the US. We can't still see the recession. In fact, the entire OECD industrial production is troughing and turning around. So something is clearly happening globally right now that the Eurozone especially is not keeping up with. When I think this goes back to our big call that we're not going to have a cent in the Eurozone, which we still don't. In terms of data coming up next week, we already spoke about CPI, that's the big data. We can actually see, this kind of momentum that we've seen since June in surprise data, obviously coincided with the equity market, and obviously a bit lower recession probability in the US. It will probably keep up its momentum for some time. Now, on a global basis, just very briefly, we still, like the global trade numbers that are developing very, very strongly. We look at the global credit impulse indicators, the US, and obviously break down each and every country. We can't really see the squeeze. We do see a squeeze by the ECB, but then again, we have no assets being riding on the ECB in that sense. What I think is a bit interesting, if you look at behavioral finance, but you actually put it in numbers. We listen to what people say, but we address it with numbers. We go through the entire US economy from a retail sales level all the way up through endowments, states, municipalities, governments, and actually look at what is their actual equity position. You can actually come up with a broad number for the entire US economy of 45%. Now, that's a bit fluky number given the individual spread you can see there, but it will tell you something about 4.5% return next year. And I think this goes back to the whole huba that we can express a degree of nervousness, but we all understand why the market is less prone to sell than to buy in this environment, given the fact that what we're seeing on the inflation side. I will stop there, and I will be back in 2 weeks' time. So we will be on a business trip next week, but we'll be back in 2 weeks' time. So I hope to see you then, and thank you so much for your attention.